Brought to you by Tailored Wealth, helping business leaders live their version of a rich life.
Welcome to another edition of the Making Sense of Your Money podcast, where we cut through the financial noise and help business leaders to make smart, confident money decisions. Welcome to episode number 35 of the Making Sense of Your Money podcast. I am your host, Dan Pascone. I'm the founder and CEO of Tailored Wealth. And as always, each episode features a trusted voice in the financial world, bringing their expertise to help high achievers to confidently make sense of their money. And today I'm pumped. We've got a great guest with us. We've got with us Alessandro Chesser, who is the CEO of Dynasty. And him and his team are doing some really, really unique stuff in the qualified business stock space. So I'm excited to learn more about this topic. And thanks for joining us today, Alessandro. Great having you, man.
Thanks for having me.
You bet. You bet. So we've got a lot to cover. I know our audience is going to want to hear a bunch about your background, your expertise, and what you and your team are doing right now. But if you don't mind, just give us a quick 90-second overview of who you are, what your background's like, and what got you to ultimately found and start Dynasty.
Yeah, perfect. So the first 10 years of my career were in financial services. Literally, my very first job was at Bank of America, and then I ended up at Wells Fargo, Washington Mutual. I did a banking circuit, and I always was on the sales side of the bank, helping high net worth individuals with anything they need help with, deposit accounts, loans, investments, whatever. I mean, that's where I got my feet wet with learning about trust and why the richest people use trust to protect assets and reduce taxes. And so the banks actually trained us on like how to interpret trust documents and what to look for and how to talk to clients about them. The second half of my career has been in Silicon Valley technology companies. I wound up at Carta as the very first sales hire in 2014. I ended up running sales. I was head of sales basically for nearly 8 years over there, and helped take the company from zero to over $300 million in annual recurring revenue. Hired hundreds of people and really got a good sense of what it takes to build a business. And so that's exactly what I'm doing now. I left Carta, and my two co-founders were also first employees at Carta. And so we started Dynasty, and it's really tying together the very beginning of my career and then the second half of my career, is financial services and understanding trust documents. And then the second half, like software and democratizing legal documents that lawyers were generating. So really just putting those two things together, and we're working on democratizing the most powerful financial instrument that exists for Americans today, which are trust documents. And specifically, we're democratizing these Nevada trusts, which are, the trusts that the billionaires use to protect assets from lawsuits and creditors, and also to reduce taxes.
All right. So a lot to unpack there. That's a really good overview. Let's start at the foundational level, because I talk a lot about the platforms, the vehicles, the strategies that wealthy people use, specifically from a tax perspective. Talk a little bit about why do the wealthiest people use trusts? And then I want you to maybe explain a little bit more about this Nevada trust concept, if you would.
Yeah. So in general, the broadest use case for a trust is to help your family get access to your assets when you pass away without having to go through the probate court system.
Right.
That's like the mass market use case. The biggest reason why somebody creates a trust is because it's better than a will. Wills have to go through probate court when you die. Trusts do not. And so probate court is this, 12 to 18 month process. It could be a lot longer than 18 months. I've seen it last like 5-6 years sometimes. It depends how well the family gets along and whether or not they're challenging the will. When you have a will and you die, the government is going to have to process your estate. The difference with a simple revocable trust is you're setting up an entity that will process your estate after you die, not with the government being involved, but with a successor trustee, whoever you appoint.
Right.
And they will process your estate after you die. And so the difference is you're not going to have all the fees associated with probate. There's not going to be lawyers involved, helping beneficiaries fight for a greater claim in your estate. And probate tears families apart. Like people go to court, anybody can show up, anybody can claim assets. And so We call probate court the biggest tax on non-rich Americans that exists. And people think that, oh yeah, I just need a will. No, if you have a will, like that's going to go through probate, and probate is going to cause a lot of friction. And so that's the biggest use case to create a trust, because it helps your family avoid probate court when you die. Now, the Nevada trust, and there's different type of trust. There's revocable and then there's irrevocable. Revocable trust means you can revoke it. If I'm the trust creator, then a revocable trust is like my account that I'm creating and I'm the owner of that account. I can change it. I can take it away at any time. Then there's irrevocable trust. Irrevocable trust, once I create it, is permanent. I can't take it away from the beneficiary that I gave it to. And so the irrevocable trusts are the trusts that actually have more of asset protection and tax advantages. And then specifically Nevada Irrevocable Trust, which, we became a licensed Nevada trust company. So we help people set up and we help people maintain Nevada trusts by serving as the Nevada trustee.
Right.
So when you're going to use like one of these, either Nevada Trust or South Dakota Trust, those are the two best states in the country when it comes to trusts. The reason why is because they have the best laws for asset protection and taxes. It's basically like moving your money to Switzerland. A properly drafted Nevada trust cannot be penetrated by almost anybody. Lawsuits, creditors, bankruptcy, divorce, nothing can touch it unless it's a federal judgment. The federal government can open up a Nevada trust. Anything that happens, like if I live in California and I get sued in California, a judge cannot touch my properly drafted Nevada trust. Right. And so Nevada and South Dakota trusts are the best when it comes to asset protection, but they're also the best when it comes to taxes. They have 0% state tax. On top of that, they have really generous rules that allow the trust to exist for hundreds of years without ever paying estate taxes. So the trust can go from my children to their children to their children, and it can just go from generation to generation, never paying that 40% estate tax. And then there's other tax benefits to creating a trust depending on what type of trust you create. And so we are a licensed Nevada trust company, full stack. We're the only full stack Nevada trust company that exists. We create Nevada trust, we serve as the Nevada trustee, and we file the tax returns for the trust. Like we're the only one that does it all. But we're not focused on creating trust for just anyone. Right now, our narrow product that we're offering is specifically for startup founders. We're helping startup founders get more qualified small business stock, which is its own area. And I don't know if your audience has any experience with QSBS.
Let's unpack that now. So let's go into, that's a great description of the trust. I'm sure we'll circle back because there's a correlation between the two. But why don't you explain, what does qualified small business stock mean from the purpose and the benefit of a founder?
Yeah, so qualified small business stock will give you, depending on when the company was formed or when the shares were issued, anywhere from $10 to $15 million in tax-free capital gains when you sell your company. And so this is mainly for startup companies or small businesses. They have to be technology companies, though. They can't be services businesses. So people who have like an online, wine store, for example, that could qualify for QSBS. It has to be a C Corp. It can't be an LLC or an S Corp. It has to be C Corp. And you have to hold the shares for at least 5 years. If you hold the shares for 5 years or more, you sell the company is qualified, or they sell the shares. You don't even have to be a founder. You could be a employee or you could be an investor. If you hold the shares for 5 years and then sell, that the first 10 or $15 million, depending on when the shares were issued, will be 100% tax-free. And so that's QSBS. It's the greatest tax exemption that exists, but it's limited. You only get either a $10 or $15 million exemption, depending on when the company is formed. And I'm just going to use $10 million for this, because for any company that was issuing shares before February or before July 4th of this year, it's a $10 million exemption, not a $15 million exemption. So it's a $10 million exemption. So what Dynasty does, everybody can, anybody who has QSBS eligible stock can sell up to $10 million and pay zero taxes. What we do is we help people create trusts for beneficiaries, Nevada Irrevocable Trust. Each trust will get its own $10 million QSBS exemption. So there's a very famous example of this. The CEO of Roblox, he created 12 trusts for Roblox, and it's written about in the New York Times, took Roblox public and ended up with $120 million in tax-free capital gains. Greatest tax exemption that exists.
Yeah. I've read about that one. And My son spends a lot of time on Roblox, so I've gotten to know it a little bit more intimately. All right, that's very cool. All right, so let's walk through the journey of a founder. Let's talk about maybe a SaaS founder, right? Let's just keep a pretty typical founder. They are in the startup phase. They want to issue qualified small business stock. Walk us through how your team helps them and what that process looks like.
Our team doesn't help you like structure your like QSBS eligibility. We have partners that do that if you need help with that. There's lawyers or there's Carta, for example, my old employer, they help. They can help you make sure that your company is eligible for QSBS. Once you're eligible, what we do is we help you get more QSBS. So
Right.
we help you create the trust for your family, for your children, for your parents, for your siblings, for your spouse, whoever. And each of these trusts, you're going to gift some of your shares to, and each one will get a $10 million QSBS exemption.
Got it. Now, listen, when you're in the startup phase, walk us through sort of like the psyche of a founder and like the thought process around this. I'm like knee deep in my business. I'm trying to figure out how to maybe get product market fit and scale the entity. What would be your suggestion, your advice to folks that are just thinking, I just want to figure out how to make money first, let alone, what I do with all the money, hopefully years down the road. What would be your advice and your mindset for folks that are in that position?
It's a chicken and egg problem because if you wait until your company has like serious traction and then you try to do it, now you're limited because now your company has too much traction, your shares are worth too much money, and you're going to chew up your lifetime gift exemption. You can only gift up to $14 million in your lifetime without paying gift taxes.
Right.
Every dollar over $14 million will get taxed at 40% federal tax,
Right.
sometimes even state tax. So the best time to do this is when you have no traction. And when you have it, is early on. The earlier, the better, because your shares are worth zero pretty much.
Right.
You can gift it out and you can preserve your entire exemption. The only risk, it's not like it takes a lot of time to set these up. We can set them up in one day. The risk is the money you pay us. And we charge $1,500 a year for up to 4 trusts. So if your business goes out of business in 3 years, you lost $4,500. That's your downside. It's a fixed downside.
Right.
Your upside, on the other hand, it's, you have the ability to generate an additional $40 million and pay zero taxes.
Got it. All right. So I know you told me that you guys have a lot of, speaking of traction, you have a lot of traction right now. Tell me a little bit about how you're like educating founders that they need this. And, back to my earlier question, there's no doubt that you want to do it when you don't have traction, but how do you kind of get them to understand that in the context of, I've got so much going on around me, I just want to figure out how to make this business a success?
Like we have people that do it like day one for sure. And they just like, this is just like getting your ducks in a row.
Yep.
Like, you don't need to think too much about it. You sign up, you pay $1,500, you give us 3 or 4 beneficiaries, we create the trust. Like,
it's a pretty simple process from there, as long as
we've made it simple. You're not having to go to a lawyer. You're not having to go to another separate trust company. You're not having to talk to a CPA. Like, you just go in and you sign up and we'll take care of you. So, that's the whole reason why we exist. We make it possible for founders from day one. It's up to you. Like, there's people, I'll tell you a story. My old colleague who was the general counsel, he's the general counsel for Carta. He's a former corporate lawyer for Cooley, a big corporate law firm. He's very experienced. In the very beginning of Carta, I was talking to him about QSBS. He's like, all I care about is building a big company. Like, that's not a problem for me today, blah, blah, blah. Well, guess what? By the time he cared, it was way too late.
Right.
And now he kicks himself every single time he talks to me. He's like, I should have planned for this. I should have set it up. I should have exercised early so I can get it. Now it's a big deal.
Right.
So like, say you don't care about it now all you want, but guess what? Someday you might, and it may be the biggest mistake you ever made.
Yeah. I mean, it's funny. You hear so many of those stories in various avenues, and especially around company stock. And there's probably 5 different topics within company equity that I could give you horror stories on that are similar to the one you just gave. So that makes a lot of sense. Tell me a little bit about maybe the education that you're doing with the founder community that helps them to understand that they need this, so that they avoid the mistake that in the example you just gave.
I mean, we're trying, education. We're doing it through LinkedIn. We're doing it through Twitter. I got to do more of these podcasts so I can create more videos and distribute that. But like social media, that's it. That's like the best way for us to Excuse me, to do it today. Other than that, like we educate them when I get on the phone with them and do a sales call. Like that's about as good as we can get right now.
Yeah, and it seems like, I mean, what you guys are offering is pretty niche and pretty focused. So tell me a little bit about like maybe your founder's mindset. Obviously, you've got sort of the two different levels of experience that you brought together now, one being on the actual financial services side and one being on the company equity and tech side at Carta. But like, what prompted you and your founders to feel like there was a product within this type of trust offering?
We learned about it because one of our investors at Carta did this early on and ended up selling $40 million in stock and paid zero taxes. And I paid maximum taxes. So like when I sold my stock, and so I was like, wait a second, like, why doesn't everybody do this? Why? Well, because it costs hundreds of thousands of dollars to set up. And so that was kind of the aha moment for like, we should solve this problem. Yes, it's a very narrow problem, a
Yep.
very specific problem. But like when you're building a startup company, there's a whole philosophy around like, let's go after the most narrow market possible where there's no competition, and let's own the market and then expand the market inch by inch. And this came from Peter Thiel and PayPal. Like he started with just eBay, and then inch by inch he expanded outside of eBay with PayPal, and PayPal's a massive company now. So that's the idea: is you don't go after a big market because big markets have lots of competition. You tackle a big market long term, but you pick a very narrow market short term to go and own and dominate.
Sure. Yeah. Well said. Completely agree with that. Tell me a little bit about how have you seen maybe not your offering, because I don't think your offering has changed at all, but has the education that you're doing and the conversations that you're having with folks before and after the recent tax code was passed, have those conversations changed at all? And if so, how?
Most people I talk to now are familiar with QSBS because the recent tax code changes like got everybody interested in it. What's going on? What is this? So I think that it's been a very positive thing because like there's a lot more awareness for sure. People still don't know what's going on, but like they know that something is there, and it's created a lot of interest in our company.
Yeah, sure. Definitely awareness to it. I've seen that myself. Well said. Okay, very cool. And then the types of folks that should be potentially talking to you and learning about this concept. You mentioned it earlier, it's usually some form of technology company, but if you had to break it down and say, who are the types of organizations that should be looking to set up these trusts and incorporate their qualified business stock?
Anybody who owns more than 2% of a C corp that is not a services company.
Okay.
Can't be like a.
Why
Yeah.
2%? Why is 2% the magic number?
It's just a rough number, and I base that on like if there's $1 billion exit, then 2% is like $20 million. And so at that point, you've just been taxed on half of that, significantly taxed on half of that. So I just base it off a $1 billion exit, which a lot of startups are aiming for at least $1 billion exit, especially nowadays. There's so many $1 billion companies out there. That's pretty much what it comes down to. But, there's like bootstrapped technology companies that have been around for 20 years that, they're not going to have $1 billion exit, but the founder owns like 80%. Like it's going to be very relevant for them. That's why I see like anybody who owns more than 2%. And if it's like a non-services company, C Corp, like most of the revenue cannot be services revenue. It has to be some type of like software or technologies.
Why is that? Just curious. Why does that?
The purpose of QSBS is to incentivize like startups, like technology focused startup, is to encourage investors to invest in startup companies,
Right.
and to create innovation and growth for the economy. Not only create jobs, but create innovation. That's the whole purpose of it. And the rules were created originally in the early 90s, and like that's why we're the leader in the world when it comes to tech. Like this is one of the reasons why, because we're all the investors want to invest in rather than investing in like public stock markets, or rather than investing in like other different type of cryptocurrencies. Like a lot of them are drawn to venture capital specifically and investing in startup companies because the QSBS exemption allows them to like get significantly greater returns.
Yep. Well said. Well said. That's a great breakdown. So anybody that owns 2% or more, non-service based C Corp, whether they're the founder or not, they really should be thinking about this. And then the question I always ask is, when should they be thinking about it? I'm assuming your answer is like yesterday, right? Or
Yesterday,
right away.
always. The closer to incorporation you can get, the better.
Okay. When is it too late?
It's never too late. You can, even if you have like $1 billion worth of stock now and like you're going to exit, you can still do it, but you can only do 14 million of that billion. You're limited and you're going to use your entire lifetime exemption. So you may still want to do it. You probably still do it because like it's never too late to get assets out of your name. Like any wealth manager will tell you that.
Yep.
You want it, the earlier the better if it's a high appreciating asset, but like you use it at some point, like use your exemption. If it's too late, like there's no such thing as too late. Like you can always gift as long as you haven't gifted before. It's too late if you've already gifted.
Right.
Like let's say you've already used your entire lifetime. That's why you don't want to do that. You use that 14 million, then you're done. Once you use it, you lose it. And so that is too late. You can't do it again next time. And so you want to do it when the shares are worth nothing. That's the best time to do it.
Got it. Well said. All right. That's a great breakdown. We're going to shift gears a little bit now, Alessandro, and we're going to allow the audience to get to know you a little bit more. So you are officially entering the lightning round. We never tell our guests about this ahead of time. The idea here is just to let them get to know you a little bit more. So all I ask is the first thought that comes to your head could be a one-word answer, could be a long drawn-out thought. You ready? Coffee or tea? One meal for the rest of your life. What is it?
Pizza.
Pizza. All right. Any specific?
It's not the healthiest, but like it's my favorite.
Any
like
specific pizza spot that you love?
I like deep dish, and in the Bay Area we have like Zachary's, and Zachary's probably is the one.
Cool. Sounds
Little
good.
Star. Actually, I like Little Star even better.
Okay. Very cool. Very cool.
In Chicago, I like Gino's East, all the deep dish.
All right. You're a deep dish guy. All right. Sounds good. So you're in the Bay now. Are you from the Bay originally?
Originally, born and raised.
Okay, cool. Got it. All right. You're a tech guy now. What's one tool or piece of technology other than your computer or your phone that you can't live without? Could be hardware or software.
Nowadays, NOLA AI, it's a note taker. It's incredible. It transcribes my meeting for me into notes, digestible notes. It doesn't record the meeting. It literally just takes notes. Like that's for a salesperson who knows how many 20 meetings, sales calls a day. It allows me to be much more efficient with my tracking and my follow-ups.
Love it. Love it. Yeah, there's a lot of those out there, but that sounds like a good one, especially because it doesn't actually record the meeting, which is a differentiator from many of those pieces of technology. Cool.
People are scared of recording, so there's no recording. It's just literally a note taker. That's it.
Love it. Love it. Favorite quote or phrase about money or success?
Nothing, control everything. It's a quote from John Rockefeller. It was all about trust. It's exactly what we do. Like my t-shirt doesn't say it right now, but I have a t-shirt that say, "Oh, nothing control." It's trust. Give everything away to a trust. You don't own it anymore, but you control it. Now you can't lose it if you get sued or you get divorced, but still having the ability to control it allows you to, take advantage of some of the benefits.
Very powerful. Very powerful. Do you have a favorite book on finance or business?
How to Win Friends and Influence People by Dale Carnegie. It's the best book when it comes to sales. There's all these sales books, and like my old CEO at Carta made me read every single one of them. He made me and all my other colleagues read them. That one was the best because it's not like how to trick people into buying products. It's more like how to be a really good person so that people listen to you. And the best way to do that is to like listen to them and like think about their interests first and just care about them and like be genuine and like people, and then you'll be influencing people. So I think that's, to me, that's the most important thing when it comes to sales. Like you got to be honest, you got to be a good person. You need to speak in terms of the other person's interest, know what they're interested in, and like just argue that.
It's a classic book, and that concept is timeless, right? Like care about what other people's interests are and what they're all about, and that gives you in turn a lot of influence. Well said. Do you have a personal hack you can share with the audience?
Personal hack?
Yeah.
My personal hack is I shave my head. I don't have to go get haircuts. I don't have time. I don't have time to do it. And so like I got 2 little kids and I got a startup company and
awesome.
like.
How old are your kids?
2 and 4.
Awesome. Very cool. Very cool.
Yeah. So that's my big hack. Shave your head. You don't have to worry about it.
I love it. I love it. What's one bucket list item you've already accomplished?
Starting a startup.
Very cool. Very cool. And then tell us about a milestone you're working towards. Business, life, whatever.
Series A.
Very cool. Very cool. Last one. If you could give one piece of advice to your younger self, what would it be?
Just live. Don't worry about the future. Don't worry about the past. Just live. Just live day to day. Take it day by day. Don't be afraid to fail at anything you do. And like in the grand scheme of things, all this stuff is not important. What's important is my 2-year-old, my 4-year-old, my wife, like keeping my family safe and healthy and happy. That's what's important. Nothing. Once you have kids, you start to realize that like all the small stuff doesn't matter.
Yeah, sure. Well said. I completely agree with that. I've seen that myself. All right. And then if our listeners want to connect with you, collaborate with you, or learn more about Dynasty, tell us where we can find you. You mentioned some of the social media stuff earlier, but tell us where we can find you.
LinkedIn or Twitter. It's Alessandro Chesser, LinkedIn or Twitter. You'll find me.
Very cool. Very cool. Awesome. Alessandro, thanks so much for sharing your time and your insights today. Really, really cool stuff, man. Thanks for being on.
Thanks for having me.
You bet, man. That's it for the episode. You can find our podcast along with our newsletter and our YouTube channel all for free at makingsenseofyourmoney.com. And as always, prioritize your version of a rich life. Cheers.